Today we're joined live from Germany by Alistair Dieppe from the World Bank. Alistair will speak to his recent book, Global Productivity, Trends, Drivers and Policies. This book presents the first comprehensive analysis of the evolution and drivers of productivity post-COVID. The book presents a wide range of policies needed to revive productivity growth. Prior to joining the World Bank in 2018, Alistair worked in the Directorate General International of the ECB, analysing and forecasting the global economy and studying linkages between advanced and emerging markets. Our in-house panel today consists of Dr. Patrick Nolan. He's the Director of Economics and Research at the Productivity Commission. Patrick also spent 5 years as the Chief Economist at Reform, a cross-party British think tank. Tim Ng is the Chief Economic Advisor at Treasury. He is a macroeconomist by training. And Paul Conway is an economist working at the Bank of New Zealand. He was previously the Director of Economics and Research at the Productivity Commission. Paul has also worked internationally at the OECD and with the World Bank. You at home, I was going to say, or at your work, you'll have an opportunity to ask questions of both Alistair and the panellists. So you just type them into the chat as we go. And also just to let you know that you're able to adjust your browser window so that you have a split screen and you'll be able to see the presenter and the presentation at the size that suits you. So without further ado, I'd like to hand us over to Alistair Dieppe. Thank you, Alistair, for joining us.
Thank you, Ruth. It's a great pleasure to participate in this event. I think this is one of the positive aspects of COVID-19 is that we have more of these online interactions across the world. So I'm going to give a brief presentation today of the new book that we've produced on global productivity, trends, drivers and policies. This is very much a collaborative effort. There's many authors from the World Bank, but we've also collaborated with academics and policy advisors, and we have a huge team beyond the authors of the different chapters. So why have we done this book on productivity? As Ruth just mentioned, there's four kind of aspects that we're highlighting that we kind of did this book. The first is that we've tried to do a comprehensive assessment of productivity. We have trends, drivers, convergence, disasters, structural transformation and employment displacement. We have a very much emphasis on emerging and developing economies. We have an overarching global view, but we also dig down into the regional dimension. We have analysis of COVID-19, examining the critical role of human capital accumulation, investment, global integration. And finally, we have multiple approaches. We're doing macro, sectoral and firm level productivity. In the interest of time, I'm going to skip some of the slides. So what I want to do today is focus on four broad questions. The first one is, how has productivity evolved? Second is, what have been the drivers? Third is, what are the prospects in light of COVID-19? And then I'm going to wrap up with looking at the policy implications of all of this. So the first question is, broadly, how has productivity evolved? And I want to start by recalling some basic kind of stylized facts, which is that emerging and developing economies are substantially below advanced economies. They're 1/5 on average advanced economy productivity, labor productivity we're talking about here. Output per worker in 2000 US dollars terms is 1/5 of advanced economies. On the average, LICS is even lower, 1/50th. So there's a substantial gap between the average emerging and about average advanced. If we look at across the regions, this gap remains. There is heterogeneity across the regions. The Middle East and North Africa has higher productivity on average. Sub-Saharan Africa and South Asia has low productivity, but the gap between advanced economies and emerging markets is still remains quite large. One of the reasons we've done this study in the World Bank is because productivity is a key driver of income growth, but it's also a key driver of productivity growth. The chart on the right-hand side here is showing that productivity in the fastest growing countries, poverty rate has declined by about 10 percentage points, whereas those countries that have the slowest growing productivity rate, poverty rates have actually been increasing. So turning to the evolution of productivity, there's two things to highlight, which is that productivity growth has seen surges and declines over the past few decades. Here I'm highlighting on the left-hand side chart, we're highlighting the grey bars, which is recessions, and we see the productivity growth has tended to decline after recessions and often surge prior to recessions. A lot of what we're going to focus on today is the period after the global financial crisis, where there's been a broad-based slowdown across a whole number of economies. This slowdown from the pre-2008 period to the after 2008 period, the magnitude of the slowdown has been the largest, the magnitude of the rebound has been the smallest, and the number of countries affected in emerging and developing economies has been the largest. So nearly 70% of emerging and developing economies have seen a slowdown in productivity growth compared to the period previous to the 2008 global financial crisis. So if we look at this broad perspective, starting from the 1970s, we see that during the 70s, 80s and 90s, advanced economies' productivity growth was on average growing faster, considerably faster than emerging developing economies, which means the gap was getting larger between emerging developing economies and advanced economies. Around the 2000s, that switched around. There was quite a substantial slowdown in advanced economies, whereas emerging markets and developing economies had less of a slowdown, which means they're catching up, they're converging to advanced economies. On the right-hand side chart, we're showing this annual convergence rate. And what you see is that, there is some catch-up, but this catch-up has been slowing over the last 10 years. And at the current rate, it will take 100 years, more than 100 years, to halve the gap with advanced economies. So the rate of convergence is still relatively slow. Now, one of the things we've done is to try and understand a bit more what's going on behind these broad trends that I just outlined. The first decomposition I'm going to present here is the traditional, what we call the traditional decomposition into total factor productivity, capital deepening and human capital. And what we see that in emerging and developing economies, the productivity growth was quite low, was picking up. In particular, capital deepening was driving this pickup. And then in the 2003-2008 period, TFP also was quite strongly supporting that. In terms of the slowdown in the 2013-2018 period, roughly half was due to capital deepening and half was due to a slowdown in total factor productivity. And that holds across many of the regions. So you see this in East Asia Pacific with China. Was a slowdown in capital deepening. That's partly a policy-driven aspect, but also a slowdown in TFP. But you also see that in Europe and Central Asia, where there was the euro area debt crisis that was driving a lot of that. But you see this also in other regions. Some exceptions are sub-Saharan Africa, where there's actually an increase in capital deepening, but there's offset by a strong decrease in TFP. Now, there's many other ways to decompose labour productivity. One way we're showing here is an alternative way of identifying technology. So here we're identifying technology as the kind of long-run driver of productivity. And then the rest is utilization. So, this captures how much workers are working, how much capital is being used, and captures other cyclical factors such as debt or investment or aspects like that. And what we're seeing in this decomposition is that if we take the 2007-2009 period, where there's a strong decrease in labour productivity during that recession, we're seeing that in advanced economies, a lot of that was due to cyclical utilization factors, Whereas in emerging and developing economies, a lot of that, nearly half was due to this technology or more structural slowdown. And that holds across both commodity exporters and commodity importers. Now, I mentioned earlier that there was this broad-based slowdown in labour productivity, and on the right-hand side chart here, we're showing that the correlations within the emerging and developing economies, and you see that there has been periods where there's a fairly high correlation of labour productivity, particularly at TFP. But if we strip out the cyclical aspects and just focus on the long-run technological structural aspects, the correlation is quite slow. And we think that points towards this diffusion of technology across countries actually takes time, is actually very slow moving. This chart also holds if we look at emerging markets compared to advanced economies. And that is in line with a lot of literature coming out from Diego Comin and others, Levchenko and others. So then I'm turning now to the second question, which is what are the drivers, particularly given the slowdown in growth of labour productivity. So what we did here is we looked at a whole range of drivers of, there's a huge literature about them, and we've done a literature review in the book. And we looked at, a lot of the drivers out there. So things like investment, innovation, gender equality, urbanization, economic complexity, education, institutions. A lot of these drivers, the countries that have good conditions in these, good initial conditions, often have higher productivity. But what we've seen is that in the last decade, there's been a slowdown in many of these drivers. So the investment as a share to GDP has been slowing down, the rate of innovation has been slowing down, income inequality has been slowing down, education has been slowing down. A lot of this is what you'd expect as countries catch up. There's been a big catch up in education. There's been a closing of the gap to advanced economies. And as that gap closed, you would expect that there's a slowing down in the pace of that. So some of this is normal, but there's a broad-based slowdown across many of these indicators. One of the indicators that comes out in our analysis is economic complexity. So this is the specialization of your exports. The more specialized you are, and the wider variety of trading partners you have, that seems an important driver of productivity, and that has also been slowing in many emerging and developing economies. Another way to decompose is to look at the sectoral contribution of productivity. So here we have a new database, a 9-sector database for 103 economies. So we've made that available on our website, and there's a lot of research can be done on that. What I'm showing here is 2 charts which show the within sector contribution to labour productivity and the between sector. That's when you shift away from low productivity to high productivity sectors. Now, previously, this shift, this between sector contribution, has been quite an important driver of productivity growth. You see that both in the 1990s and the 2003-2008 period. But in the recent 5-year period, 2013-2017, that's about a 4-year period, there's been a substantial slowdown in this between sector. You see this in advanced economies. There's been quite a lot of documentation about that in advanced economies. There's been less documentation about that in emerging and developing economies, where there's quite a substantial slowdown. And particularly in LICs, there's also been a slowdown there, low-income countries. On the right-hand chart, we show the gap, the average gap within a country, within emerging and developing economies or within advanced economies across the sectors. And there's 2 points to highlight here. First, the gap is quite substantial in emerging and developing economies, particularly agriculture. Agriculture is quite low compared to the average sectors, whereas sectors like manufacturing, transport, utility finance are above. So there's still quite substantial gains to be made by switching away from agriculture and some other sectors to more productive sectors. The second thing to notice is that this gap is much narrower in advanced economies. So in some ways, it's not surprising that there's a dwindling in advanced economies of this reallocation effect. So on to the third question, which is that the world has been hit by COVID-19, and what are the implications of all of this? What's the outlook given that? So we have a chapter in the book where we looked at disasters. We looked at a whole range of disasters: natural disasters, wars, financial crisis, And one of the first points to notice is that natural disasters are much more frequent than wars and financial crisis, and they've been increasing, substantial increasing over the last few decades. If we break down natural disasters into three aspects, we have climate disasters are by far the most dominant. So this includes things like flooding, extreme temperatures. Then we have biological disasters, which include insect infestations, and then geophysical disasters. So the climate disasters have been increasing substantially. These natural disasters have been hitting all regions, all main regions, but some regions are more affected by others, sub-Saharan Africa, for example. We have studied the implications of these disasters on productivity. And what we're reporting here is our results, and we also report the literature. We did a literature review on this. And the main message that comes out of this is that these disasters have a substantial impact on productivity, and a persistent impact that lasts for many years. Negative, mostly on average, it's a negative effect. Both across disasters. Wars are particularly devastating, financial crisis also. We've seen that the global financial crisis had a persisting effect to some degree on that. We scale this up by the frequency, and if you take into account the frequency, then natural disasters, on average are dragging down labour productivity by about 0.2% each year. We also looked at the effects on epidemics. We focused on 4 epidemics. They also had, have a persistent negative effect. And COVID-19 is obviously a larger effect than the 4 epidemics we studied, but it's a lot of this was driven by an uncertainty effect. So turning to the prospects, given all this, there was already a slowdown in labour productivity. Then COVID-19 hits, and we think that provides dim prospects in the short term. There's weaker investment, there's a hit to trade, there's a substantial erosion of human capital, schooling has been affected, there's been increase in unemployment, there's been some shifts in labour markets, but it also leads in the short term to slowing momentum in labour reallocation. Some of the restrictions in place mean people cannot easily switch across sectors. There's also been a heavy debt burden, increasing debt burden, which also drags down labour productivity. On the other hand, there are some positive potential upsides from COVID-19. This can be organisation, can be a trigger for organisation and technological changes. There can be lead to more diverse and resilient supply chains, which we think could be a positive effect for labour productivity. There could be improvements in education, there could be in financial developments, but a lot of this is conditional on having the technological infrastructure and having the education in place. So if I can turn to the last question, which is the policy implications. So we think there's no silver bullet. There needs to be a comprehensive approach. Many of these aspects are interlinked. There's no one way to boost productivity. So we're highlighting here 4 aspects that we think are needed some ways in order to have a substantial boost to productivity. The first is to stimulate investment and improve human capital. So this is, if you take in a kind of solar decomposition, that's an important aspect. And that has been dwindling in many countries. Second is to facilitate the mobility and reallocation of resources to more productive, more diverse sectors. We've seen there's still substantial scope for this, particularly in emerging developing economies where, for example, agriculture is still, the productivity of agriculture is still substantially behind advanced economies. Third, I haven't really touched upon this, but we do some analysis of the firm level, and it's important to have the right policies in place in order to support the growth at the firm level, encourage investment, encourage innovation at that level. And then fourthly, many of the technological improvements can lead to labour market disruptions. They can lead to higher unemployment, and it's important to have measures to manage that labour market disruption. And we've done some analysis on that to show that both emerging and advanced economies see disruptions to the labour market from technological improvements. The aim of bringing all this together, the aim is to kind of have, building back to better after the COVID-19 pandemic. I just want to highlight in particular, one of the policies that came out from our analysis is the importance of fiscal space. Countries that have low debt level or have fiscal space often are hit less by shocks, by negative disasters or negative banking currency climate. They can some degree offset that. And that also holds for demand shocks that can affect productivity growth. Countries with low debt levels tend to have much less of a hit to productivity growth than countries with high debt levels. So I'm going to wrap up there. What I've tried to highlight is four aspects. Firstly, there's been a broad-based decline across many countries, a slowdown driven by subdued investment slowing TFP. Many of the drivers are slowing, many of the kind of, whole range of drivers are slowing. Sectoral reallocation is weakening. Already, the shock of COVID-19 and the increasing shocks that have been hitting the economy are compounding the slowdown. So the outlook is, in some ways is negative, although there can be some offsetting positive effects. And in terms of policy implications, there's no silver bullet. A lot of it's interconnected. Improve your education, improve innovation. It all kind of increase your trade. A lot of these factors have a stable economy. A lot of them all interacted and need to be a kind of comprehensive approach to boost it. So thank you very much for your attention. I look forward to the discussion.
Alistair, thank you so much for that. It was probably beyond a lot of my comprehension, but I'm sure our learned friends have picked the gist up and have something to speak into there. So would either of you, any of you like to speak about this? Perhaps you, Patrick.
I'm happy to start. Well, thank you very much, Alistair. That was a very fascinating and useful presentation. I mean, I think looking at it from a New Zealand perspective, I think there are a lot of themes that we share, particularly the stalling of productivity growth following the GFC. So New Zealand has had a persistently poor productivity performance for many decades. If you go back to '96, our measured sector productivity has been about 1.4%, but since the global financial crisis, it's fallen to about 1%. So again, that's consistent with the messages that you're providing there, and particularly also the impact that has on living standards and well-being, because it does flow through to sort of lower wage rates and less money being available for state services and all those sorts of things, and the impact on the living standards framework that Treasury and Tim have been working on. So I thought it was a fascinating presentation. I was very interested in your discussion about the drivers behind that, because I guess one of the key drivers in New Zealand has been a really stalling capital deepening. So probably less so than total factor productivity in New Zealand, because that probably stalled earlier in New Zealand, but we've had very slow capital deepening since the GFC in a period of quite low interest rates. So we're interested in any thoughts you might have on that.
Yes, so the one of the things that came out is that this capital slowdown and capital deepening is very broad-based, affecting a huge number of the economies. So it's not just an advanced economy. We've seen that in advanced economies where there's been quite but this has happened across a lot of economies, and we partly we think that's because of the increase in debt that happened after the global financial crisis, and that has led to a substantial decrease. We didn't look at the breakdown in terms of government and private sector. That's an angle that could be of interest to delve deeper into. But a lot of the government increase in government debt meant they weren't able to step in and provide the kind of stimulus that could be needed. And that's one of the policies that we're highlighting, is there needs to be a pickup in investment. There's gaps, right? In sub-Saharan Africa, for example, there's quite substantial gaps in the investment rate, GDP compared to many other emerging developing economies or compared to advanced economies?
Thank you, Alistair. I have a question here actually from one of our audience, Alan Bollard. He's a question to any of the panellists or yourself, Alistair. Would the inevitable build-up of COVID-related public debt have an indirect negative impacts on productivity? Anyone care to answer that one? Maybe Tim.
Sure. Hi, Alan. I think inevitably, given the magnitude of the increases in public debt we're going to see, my guess would be there has to be a crowding out at some point, because the debt will have to be stabilised and the loan reduced, and the stabilisation of that will imply some mix of revenue and expenditure consolidation in probably all developed countries, at least, if not developing ones as well. So I think the answer has to be yes. That'll be a really difficult process to go through, I suspect. If you guys
just to add, I think I think that's right, Tim. But I think it's also important to say that in the case of New Zealand, because government debt was so low going into the pandemic, and I'm not sure what the latest Treasury predictions are, but I think government debt will end up at something like 50 or 60% of GDP, which would have been a debt level that many countries internationally would have been very happy, thrilled to have going into the pandemic. So I think the dynamics that Tim's talking about are going to play out globally, but perhaps to a lesser extent in New Zealand, given our better starting point for government debt.
Thanks, Paul. And Paul, have you got anything else that you?
Sure, I've got heaps that we could talk about. Steph, thanks for the book. It's a very impressive achievement. It's over 400 pages. I kind of haven't had the chance to sort of read it in its entirety yet. I've sort of more dipped into it, but I think for anyone interested in global productivity issues, it's certainly a must read. I think it's fantastic the way you've pulled together, where the economics profession is at in terms of thinking about our productivity into the one place. I was also struck by how widespread the productivity slowdown has been. I obviously knew it was happening across OECD economies. I think it predates the global financial crisis by a few years. But it was interesting to see just how widespread globally that productivity slowdown has been, which sort of points to a common factor. And you talk about aging populations, weaknesses in the skills system, and a fall in investment. So convergence has sort of slowed down, which I think is not surprising. I believe in convergence. I think it's in the data, particularly within clubs of countries that have sort of policies in the same broad area. But it's an economic process that's very easily disrupted. So in the OECD economies, we saw strong convergence coming out of that post-war period. But by the late 90s and early 2000s, that was coming to an end, and there was some divergence there as certain countries were much better at adopting new technologies compared to other countries. So, it's hard to adopt new technologies, and I think it's getting harder as technology becomes more sophisticated. And I think it really, from a policy perspective, I think the challenge is how do we increase the capacity of economies and firms to absorb new technologies. And I think that's, an interesting sort of angle on our policy challenge. It's sort of, it maybe, you also made the point, that disasters are typically negative for productivity, which I guess isn't surprising. But given climate change, we're likely to have more disasters going forward. So what's the policy challenge there? Is there anything that policy can do to sort of mitigate the effect of a pandemic or a disaster on the productivity performance of the country in question? And is that sort of, is the nub of that challenge, is that about sort of speeding up that process of resource reallocation out of parts of our economy that have been hit by the disaster into sort of higher productivity, ideally higher wage parts of our economy? So that's kind of my first question. I've got some other stuff on policy that we can get to later. But.
So if I could respond to that, I want to pick up on two aspects here. The first was the convergence aspect. So the chart I showed in the presentation was unconditional convergence, just looking at our countries catching up or not. Okay, we also did analysis on this club convergence, and there's a number of points to make here. The first is that some countries are transitioning to the kind of top club. So there are some examples, successful examples of countries that have done this. But in general, what we find is that things like education, foreign direct investment, and having a broad trading base is some of these indicators that suggest that you are transitioning. So there are successful cases, but there's many countries that are not doing that, particularly in sub-Saharan Africa. It takes time. There's no quick, right? It takes time to kind of go up the chain and to do this. On the issue of these disasters, so these disasters have been increasing over time. Part of it might be better measurement, but actually, recently, in terms of so we use a measure of number of lives affected as an indicator of things like climate disasters. And although the frequency of these disasters have been increasing, the number affected is some way stabilizing or hasn't been going up at the same pace. So part of that is because countries have become more resilient. They have been investing in infrastructure, right, more stable infrastructure. They're undertaking preventative measures to some of these disasters, right? So like an earthquake. If you're in an earthquake zone, you're better house infrastructure. But nonetheless, these disasters are increasing, right? We've seen more, epidemics have been going, and COVID-19 is obviously, the largest and the biggest of all that. But there were, some of these SARS and the MERS and have been affecting countries, and that's why we think it's important to have, fiscal space in order to be able to respond to this. And actually, if there's a short shock, so if you have an earthquake or have a flood and then it's over, then you can invest, maybe rebuild, and actually your productivity can go up in some cases. Right? It can lead to better ways of better infrastructure. So that's why we highlight the importance of this debt aspect. And a lot depends also on, what you're investing in, right? If you do the right investments, maybe, higher debt can be positive. Not all debt is bad.
I'll just follow up on that, Alistair. And this question of convergence is really interesting because I think as economists, we'd all like to believe in convergence. My question is whether you've observed in your very extensive cross-country data set convergence at the level of the drivers of productivity. And what I have in mind is that if you read books like Why Nations Fail, people, the authors of that book say it's all about institutions, and you say institutions as one of your factors. I would have an assumption that most people want to have an improved standard of living, and the way that they express that is through political institutions, for example. So, but at various times, nations fail because they have failures of political institutions, for example. So, have you noticed any sort of correlations at the institutional investment level across your countries, or the ones that have actually managed to upgrade themselves into higher productivity clubs? Can you attribute that to the kinds of investment in institutions that you would expect, that would then lead to investments in education, increasing the returns to capital, deepening and so on through property rights, etc., etc.
So what I documented was the broad slowdown, but looking at the gap of emerging developing economies with advanced economies, there isn't, on average, there's not a general closing of that gap. In some cases, there's a widening of that gap. Now, there are many, there are differences across countries. So some countries, some countries are diverging in other areas. One of the things I highlighted was education, which has been improving substantially in terms of the number of years of schooling or the number of the population in tertiary education. But that's also been improving in advanced economies. Okay, so that, but you know, there has been a general improvement in many of these measures, but in terms of catch up to advanced economies, not so much. Now, you know, one example. So we focus quite a bit on this, on the trade and economic complexity. So many countries, there's been a substantial slowdown in advanced economies. You know, moved towards more protectionism in this regard, whereas that's been less so in emerging and developing economies. So in some ways, they're catching up in that area. In terms of the institutional framework, so you know, there has been, you know, in some countries, you know, in some ways, there's been a worsening of the rule of law. We have a measure of rule of law as an indicator. In some ways, that's been worsening in many of the regions. We have things like, so we have another indicator, which is like, we use inflation, how stable inflation is as a kind of indicator of the macro stability of the country. And you know, for some countries, that's been improving. But in terms of moving up the clubs, the factors we find important is, again, foreign direct investment. So this is the technological transfer channel, seems to help. Education is important, and yeah, economic complexity. Yeah.
Just if I can have a supplementary on the foreign direct investment one, are you sure that that is not a proxy for the types of institutional quality that would lead foreign investors to invest in the first place? I'm kind of thinking of the policy implications, right? You can open up your borders, but if you've got rampant corruption, nobody's going to invest.
Right. So we think everything's interlinked, exactly as you're saying. There's no, so it's difficult to identify. The way we did, you know, there's a lot of endogeneity as well between all of this. So the way we looked at this is we looked at, we took a snapshot in 1995 of you know, the initial conditions in 1995, and looked at productivity growth over the next 10, 20 years. And you know, there are examples of countries that have good FDI that have actually transitioned up. But we you know, again, there's no silver bullet. There's no one way to do this. You know, it's many factors out there, and we're not saying that this is the way to do it, right? It's a combination of bringing it all together. So you know, you need the right education, and in order to benefit from technological, right? In order to utilize technology for other countries, if you don't have that education, you can't do that. So there's very, and you don't have a stable rule of law, people aren't going to invest. So you know, I agree with you that it's difficult to pin down one or two aspects.
Yes.
Can I sort of segue from that into asking about your recommendation around boosting productivity at the firm level? Be really good to unpack that, if you could, because one of the dimensions is we're talking about the slowdown in productivity growth, but for a group of global frontier firms, we hadn't seen the same slowdown. In fact, in some larger economies, you've seen frontier firms pull away from you know, sort of the non-frontier firms or laggards. And even if you look in New Zealand, one of the issues we have is that our frontier firms are quite disconnected from the global frontiers. So we're seeing a growing gap between the global frontier firms and our frontier firms. And then we've got a further gap between our frontier firms and our laggards. So very interested in the issue of how we lift firm productivity. So interested in your thoughts on that.
Yeah, so we did some analysis at the firm level. We used this World Bank Enterprise Survey database, which kind of gives a snapshot across firms. And, you know, we found that large firms tend to be more productive than small firms. And the other finding that came out was that quite a lot of divergence across, if we look at the firm level, there's divergence across countries within an industry. But we're finding the firms in technological intensive industries tend to be higher to the frontier, tend to be much narrower dispersion, whereas you know, the agricultural sector, for example, has very high dispersion across countries. So, that suggests there's not much scope to, you're quite close if you're on the technological aspect. There's not big diversion. You're quite close to the frontier there. If you're in some of these others, there are quite large gaps to the frontier. So those areas are perhaps where, there can be investment that can help boost and get closer to the frontier. So measures such as promoting export, improving business climate can help close some of the gaps in those industries and sectors.
Well, great. I think I'll just interject here. There's a question come through from Galnara Nolan asking, policy settings during COVID have had a focus on sharing the burden of the crisis across people and across time, although this has been done on the basis of perceptions of fairness. Do you think that this will help support future productivity by limiting disruption and preventing a sharper decrease in human capital? Decrease future productivity by preventing necessary reallocation of capital and labour?
So one of the drivers that comes out is, inequality, increase in inequality is bad for productivity. So it's important to, have a more equitable society, and that can help productivity growth in the long run. So, measures that over the short run can support, and, a lot of disruptions, particularly affect the labour market. So providing support in the short run to kind of, provide education, to facilitate, so there's not loss of human capital, facilitate smoother transitions, reallocations of workers to other sectors, is an important policy angle that needs to be taken. And this includes things like education, right? If you educate the workforce, provide that, and provide a kind of social support, that should help to facilitate workers to transition and help, firms to be willing to invest in workers. Do the panel have thoughts on that angle?
Well, just in general, Alistair, the policy prescriptions that you sketch out in the book, I find it very rich in terms of policies around education and facilitating resources to move across sectors. And you talk about that we could, off the back of COVID, once we sort of get through this initial sort of chaos and disruptive period, that we could see an improvement in productivity if COVID sort of stimulates people to adopt technology, some digital technology, obviously being a case in point. And I think that's really vital for us here in New Zealand. And you also, I guess the other mechanism there is a pro-productivity sort of shift of resources away from, recessions tend to sort of weed out the poorer performing firms and allow those resources to flow up to more productive firms. But I think that outcome is conditional on, we've had a sort of a public health aspect to our response to the crisis or the pandemic. We've had stabilisation policies, which we talked about before. But I think, there's also a micro agenda that needs to be added into the policy mix if we are to sort of, make the most of the opportunity of rebuilding our economies in the wake of this terrible pandemic. And you sort of sketch out quite a rich policy agenda around that. It certainly seems to have come a long way from the Washington consensus, which was essentially about governments getting out of the way and letting the private sector do its thing. And I think that transition is right. I agree with you on that. And it's good to see sort of widespread discussion around that. I've become more activist in terms of my policy prescriptions since thinking about New Zealand, because I think for an economy such as New Zealand, or a country that's small and distant, the optimal set of policies are probably a bit more activist than they are in larger or better connected economies. First of all, I'd be interested to know sort of how widespread has that change been away from the Washington consensus to a richer policy prescription. And also in the book, you mentioned that you sketch out an agenda around policies that you say is kind of general, and that other policy aspects will depend on the country in question and the sort of characteristics of that country. Two characteristics of New Zealand is that we've got a very small economy, we're sparsely populated, we're also a long way away, so we're not particularly well connected internationally. And I'm just interested in what sort of policy prescriptions or what types of policies do you think that should suggest for our country if we are to make the most or to benefit in the medium term from COVID? And I hope I'm not putting you on the spot, but maybe I should say that, you know, for me, I think the fact of being so small, it really sort of highlights the importance of digital technologies, because digital sort of expands markets and gets away from sort of geographic constraints around proximity. And I also think being small, it sort of means that we have to really focus on a few growth engines in our economy. To some extent, to quote Danny Roderick, we're doomed to choose. So my second aspect of the question is, to what extent do you think that is an accurate sort of policy message to be talking about in New Zealand in the context of making the most out of this terrible thing that's befallen us?
I would like to emphasize there's no one way to boost productivity. Okay, there's different examples of countries that have successfully transitioned using, you know, different measures. Okay, so there's no one, you know, we're not saying that everybody needs to follow the same way, which is why you have the country specific example. We have a whole regional chapter where we dig down across the regions and, you know, identify gaps where, you know, it's particularly large. So, you know, for example, in sub-Saharan Africa, the gap in education or in innovation or complexity of institutions is quite large, right? Compared to other emerging developing economies or compared to advanced economies. So in those regions, they should, you know, it might be worth focusing on them aspects. Obviously, many small countries can't, you know, are small and don't have the necessary, you know, comparative advantage to build up across the whole range. So there needs to be some specialization. And that's one of the things, this is the complexity measure, which precisely is saying, you know, more specialized, you know, is one channel of doing that. The digital aspect is very important. It's something that we didn't look at in detail, but it is, you know, the world is becoming more digitalized. It's, as I mentioned earlier, the firm, you know, if you're on the digital or technological aspects, you know, the productivity gap is quite small. And, you know, it is a way to compete. We were concerned that a lot of emerging developing economies don't have the infrastructure to be able to do the digital aspects, okay? And, you know, that matters in terms of the conjunction in terms of education. A lot of education in advanced economies switched to online learning. There's more, you know, more ordering from Amazon or, yeah, and a lot of these countries just don't have that infrastructure. So we think for them, it's very important to invest, to have stable internet, fast internet, so we can have the, you know, we can have this online conversation because we both have good internet that can cope with it. But a lot of emerging developing economies don't have that. And that's a concern in some ways. They're you know, going further behind in that respect. Whereas, you know, maybe for New Zealand, that's an opportunity to, you know, participate in the global chains of that.
Yeah, and I agree with all of that, and also with Paul's remarks. I mean, I guess New Zealand is lucky in that we do have that very good infrastructure, that digital infrastructure, but there is still the issue of domestic diffusion. So when people talk about digital capabilities in firms, I'm always reminded about our management scores, and there's all the issues around firm governance and the wide sort of the tail of underperforming firms. I guess COVID has forced firms into digital, so that's really changed things. But be interested if that's a sort of a theme that you've picked up in your report, stuff around the management capabilities of firms, governance, just the absorptive capacity of firms.
So there's a lot of literature that is saying the role of management is an important driver of productivity. We didn't look so much at that, but the World Bank has many reports where that comes out as a key aspect for growth and for productivity. I also just want to touch a little bit on robots. That's also a topic out there which in some ways is also driving productivity. But it also could lead to loss of jobs, right? Could replace jobs. Many of these things, the robotics could increasingly replace labour. Artificial intelligence could also lead to some job losses. So that's also a concern, more for advanced economies, but also emerging markets if they're competing against some of these robotic aspects.
There's a couple of questions, if this is the right moment, from the audience here. We have a question from Amy Russell. Amy's asking, can you talk briefly about the things you've found that might challenge orthodox expectations or assumptions? Did the data hold any big surprises from your perspective, Alistair?
So I guess, when I started this project, the things that come out to me is I hadn't realized the extent of the slowdown, the broad-based nature of the slowdown. I knew that, in advanced economies, a lot has been written about that, but less on the emerging developing economies. And so we see this as very much broad-based. Nonetheless, this diffusion of technology, there's been a lot of talk about how quickly technology can diffuse, but what we find that others have been finding recently, so we're not the only ones finding this, is it seems to be slow within emerging developing economies, right? It might be faster in advanced economies, but within emerging developing economies, it's slow. Again, that might be linked to the digitalization and things, that's a concern. And in some ways we know this, right? So shocks have been increasing, negative shocks. So, COVID-19 in some way shouldn't have been a surprise, right? There's increasing, we had the hints of the MERS, the SARS, and, epidemics have been increasing over time, but, natural disasters, climate disasters have been increasing. So this shouldn't be a surprise to us, but in some ways, this is having a negative effect, these repeated shocks. So even if you have the right, good framework, you're hit by these shocks is dragging down, productivity. And it's not just it's also financial crises are having effect, wars are having effect. So there's many of these negative shocks, and that hits your convergence, right? Hits your catch up. So those are the things I would focus on in terms of my learning, some of the key learnings that come out for me.
Gentlemen, anybody else have anything to mention at this stage, or should we go to another question?
Well, maybe if I can just comment on Gulnara's question, which was about the imperative to provide income support on fairness grounds, while also trying not to impede adjustment processes. I guess my observation would be that's probably the critical question facing us, not only in this crisis, but in this particular COVID crisis, but more generally with increasing shocks to the system. As you say, Alistair, you can sort of interpret this through a productivity lens because it impedes convergence and everything else. But in a way, it seems more like a meta issue to me, that the increasing shocks that countries have to deal with from all sorts of perspectives, whether it's equity or productivity or sort of aggregate living standards. So I wonder if, maybe I'll turn it into a question. Have you noticed in your sample, when you've looked through your sample of countries and their responses to some of these shocks that they face, local shocks if you like, from climate or whatever, are they changing their investment strategies to, you observed actually that they have been investing in resilience, and so that the number of deaths per disaster, if you like, normalised somehow, has been falling. That's presumably good for productivity because it means you destroy less capital every time you have one of these shocks come along. Would that be a fair characterisation of the finding, of the learned lesson from that finding?
So there's been more shocks. Shocks are increasing over time, so that's dragging down. Countries in some ways are becoming more, some countries are becoming more resilient to shocks, or better able to respond to them. But the broad trend has been an increase in the number of shocks. That loss of life, there might be some stabilization of that, but that's we don't see the number of shocks decreasing.
But are you able to claim that were it not for the investment in resilience, the productivity consequences of those shocks would have been even worse,
right,
than it already is?
Right. So this is so if we look at, as I mentioned earlier, if we look at things like earthquakes, that can lead to positive. The literature out there, we've reviewed the literature. Can in some sectors can lead to a boost, right? Investment comes in from abroad. You can get foreign investment, direct investment after a shock. You can get aid, and that can lead to a boosted investment, long-term boost, right? If you rebuild the society and provide the right infrastructure, and you have the right, it's not just, it's encouraging foreign investment as well after these disasters that can help poor countries.
I could ask another question, if we've got time. I'm really interested actually in this issue of supporting people whose livelihoods have been decimated by the shock versus the need for the economy to adjust. The fact is that in New Zealand and globally, some parts of our economy, some areas of economic activity have been absolutely slammed by the pandemic, and resources are going to have to move out of those parts of our economy, ideally into higher productivity, more lucrative parts of the economy. And the conversation you've been having about more frequent disasters sort of suggests that our economies in general need to get better at this process of resource reallocation, and I think that sort of points to the lifelong learning and all that sort of thing. I also think it points to a policy framework that allows an economy to sort of flex, to move with the punches, as opposed to a policy regime where everything is sort of ossified and therefore more brittle and likely to break. So just interested, Alistair, in any sort of reflections on that. Did that sort of show up anywhere through this work?
So we do. So we haven't done. We haven't studied how flexible. It's difficult to study how flexible economies are.
And policy
indicated
settings as well.
But I would agree with you on that. I mean. In some ways, you talked about the Washington Consensus before, but in some ways, this is the role of the World Bank, right? I mean, this was done. I've now left the World Bank, moved to the European Central Bank, but this is where the World Bank or the IMF have a role, is to come in and to help countries that are hit by major shocks recover and in some ways build back to better. And we see the pandemic could be an opportunity for that. Right, it could trigger countries to do the right type of investments and provide the framework, and could actually lead to positive, and there's potential of scope there. While the outlook is negative, there's a lot of gaps. There's a lot of improvements that can be done that can boost productivity, and this could be the trigger. Right, big disasters can often be the trigger for that. So that's an optimistic.
Is that your view? Can I ask if you're an optimist or a pessimist on the long-term impacts of COVID-19 on the global economy? Is now the time for us to get it together a little more than previously and enact the types of policies that we need to build resilience? and to build more dynamic, productive economies going forward. I mean, I'm an optimist when it comes to New Zealand, which is kind of hard sometimes because their productivity performance hasn't been that great for decades. But where do you sit on the optimist, pessimistic spectrum about the long run productivity impacts of COVID-19?
Yeah, so in the short run, I'm pessimistic, right? If we've had a shock, it's going to. So the question is more on the longer run. Where it's clear that major shocks do trigger changes, right? And we're seeing that already in many aspects. So education is being disrupted. A lot of these will be long run. Online learning is increasing. That will be an increase. This video aspects we're having here will stay with us, right? It's not just a temporary thing, but we'll continue to have this. There's no need to fly out to New Zealand. We can give an online presentation, and it's worked very well. So there's been many of these, and we could have done this before, right? And we didn't. So you need that trigger. Working from home, right? We can do that now. So there's, triggers are there. But, if you look at the more global picture, there's a retreat from global value chains, protectionism going on, which will have a negative effect. There's, we've debated earlier about the role of institutional framework and stability. Shocks can lead to more instability, right? They can lead to more inequality. So some of these are negative effects. So the positive aspect is that if countries do the right framework, they can. I think there is scope for catching up. One of the debates out there is whether this slowdown in advanced economies is a more permanent, right? We haven't seen, why has not technology led to more increases in productivity? Part of that it takes time to feed through. But there is that puzzle out there, the Gordon puzzle, which is a difficult one to answer, right? I mean, we're documenting there's a broad slowdown, but whether that will then lead to pick up later is difficult to aspect.
I think I'm going to have to interject here. I think our time is up, gentlemen, but thank you very much, Alistair, for bringing this work in front of us, and very much gratitude to our panel, all of you. It was a good conversation had here today. Clearly, we've got a lot of work to do to make sure that our economy is resilient and we can actually do that resource reallocation and be nimble. And I'm really encouraged with our position here in New Zealand as to how we might start looking at that and rolling that out, given our size and our ability to be to pivot. I think we're going to need it. So thank you very much again, Alistair, and thank you very much to our audience as well. We're having another Motu Research Roundtable again on the 14th of October. We have Rebecca Henderson coming in, and she's going to be talking about her book, big subject, Reimagining Capitalism in a World on Fire. So please be sure to come back for that very important discussion. But again, thank you to everybody here today. Thank you to our audience, and we'll see you again soon. Thank you.
Thank you very much.
Thanks, Alistair. See you later.
Thank you.
Thank you.